Morgan Stanley is joining us in a minute. Good morning, Ridham.
Hi, Lata. Hi, Nimesh.
Always a pleasure to have you with us, and thank you very much for allowing us to barge into the Morgan Stanley Investor Conference. You know, I have a summary of your recently written note, and this is looking very, very bullish. You expect earnings to compound at 20%, over the next 5 years, and Nifty to triple within 5 years. 30,000 index?
Yeah, I mean, let's put it into context. So between 03 and 07, Nifty earnings compounded at 39%. Okay. And the index was up 7-fold. So this is relatively modest in that context. We did that in 4 years. In 5 years, we'll triple. The context here again is that the profit share to GDP is at close to all-time lows. So profits have really fallen off, and it's a cyclical number. It tends to recover. I think the factors have been set up for a recovery. Consumption looks like it's on a recovery path thanks to the enormous work done on inflation. So real wages are turning. Therefore, you will start seeing some recovery in jobs. Exports, which were lagging and which were really a big drag for 2 years running, have recovered as well. Government infrastructure capex is actually doing quite well. It's about to hit all-time highs. So 3 out of the 4 legs which drive the economy are in place. The fourth and the only missing leg is private capex. But as a consequence of these three, as utilization rates climb in the next 12 months, we think capex will also recover next year. So I think we are in the midst of a cyclical recovery in the economy, which obviously is good for earnings. It's not going to go up in a straight line. There are various things that will happen over the next several quarters. But I think it's fair to assume that this is a well-entrenched bull market, and therefore there's considerable more upside for a long-term investor. For somebody who's looking at it from a 3 to 6 month perspective, I can give you a lot of problems that the market is going to face. But we can come back later in this discussion.
I was going to start with that. I mean, valuations-wise, even with giving a very rich growth in the current year, we will still be, 18 times, we are at very tall valuations. And some of the FMCGs, the favorite sectors that everyone likes, we are at 40, 60 times some of the good earnings numbers. If you take an HDFC Bank, we are already at 4 times. If it's RBL, I think it'll be 5 or 6 times.
So valuations are not my concern, Lalta. Okay, I think they're a little bit stretched in the mid-cap space, small-cap space. So I think that's a concern there. But let's look at valuations. And actually, valuations can be looked at in different ways. So I look at it relative to India's own history. Now, you cite PE multiples, but remember, earnings are depressed. So PE multiples invariably are going to look a little richer because the earnings are below normal. If you normalize earnings, then the PE multiple may not be as rich as it looks right now. So therefore, I look at it in terms of price to book, which doesn't deal with cyclicality in earnings. And on price to book, India is at about close to its long-term average. So it's not cheap in the conventional sense, but it's also not rich. These are not levels at which you can make a market call on valuations. See, valuations are useful only at extreme levels, when they are too low or too high. Otherwise, you have to use other things like sentiment, like growth, and other things to judge where the market is heading. Then again, if you look at India relative to US multiples, which is the bellwether market of the world, India's valuations are just off the '08 lows. Just off the '08 lows. It tells you how rich the US markets are. Okay, so again, everything is in the context of relative positioning. So valuations don't have an absolute context. So relative to the US, India is okay. Relative to EM, yes, the valuations are above average. And that I think is kind of justified by India's superior growth and rising ROEs versus EM. I think EM has got more structural problems, so India's valuation premium is sustained. Versus bonds. So you look at the 10-year bond. 10-year bond is offering you 15 times earnings, 6.6%. Yes. Equities are 17 times. And 10-year bond only gives you a coupon for 10 years. Equity coupon continues beyond that. And the equity coupon is a growing one. The 10-year bond is a static coupon. Which one will you buy? The 10-year at 15 times or the equities at 17 times? So if you're exactly. So if you're a long-term investor, that's where I think you want to be. As I said, mid-caps, small caps, I think there's a little bit of a stretch there. because there's an earnings recovery coming, and I think as you can go back in time, we tend to underestimate both a recession in earnings as well as a recovery in earnings. So the oft-repeated comment, especially I've seen it on your channel as well, is that, you know, for the last 7 years, analysts have started the year with 15-17% earnings growth and ended the year with nothing. It's quite possible that we continue to start at 15-17%, but we end differently from the last 5-7 years. And I'll again give you history. In 2004, analysts started with 15%, ended the year at 30%. So, you know, the reverse is possible if the growth cycle is turned.
I was going to ask you, does this feel like 2003-04, and you kind of partly answered it.
It feels more like 2004, not 2003. In 2003, the index multiple was 2.1 times book, and the P multiple was 10.
Okay.
It was a very, very juicy level, very different from today. In 2004, we were somewhere around 3 times book and 17-18 times earnings, and all through 04, 05, everybody kept complaining that valuations are rich and the market kept going up, but we did get big corrections along the way. Okay, so it's not like a linear straight line move that you're going to see even now.
2004, the rate hikes also started, but anyway.
So, Ridham, you know, if this scenario plays out of a 20% CAGR growth, and you know, whatever we saw from 2003 to 2008, similar scenario plays out, this time what will lead this rally? Because every bull market has got different legs and different sectors, you know, taking the markets higher. This time, what are assumptions?
So, I think, Nimesh, financials certainly look like the place to be.
Yeah, that shows
and
in your...
consumer discretionary is the other place. Let me just talk about discretionary consumption first, then I'll come to financials. So I think we're going to underestimate consumption in this country. And the reason for this is fundamental change that's happening in the household psychology. So there's a cultural shift that's happening. My father never borrowed money. I've never borrowed money. But everybody who's 20 and 30 something in the world, in India, is now looking to borrow money. There's a big way in which people have changed their mindset versus loans. What does what does borrowing money do? It advances demand. Okay, so we will underestimate consumption in a meaningful way, because if we look at nominal GDP growth as a guide to consumption, I think consumption will be ahead of it. There's a second thing that's happening in consumption is we are approaching a J curve in the per capita income. Okay. So if you look at India's consumption basket, 60% of it is food. But now from here on, when the consumption basket grows another 10%, 6% will not be food. Okay. Because that's only that much food you can consume. So the remaining 40 will grow at 10, which is 25%. So a lot of non-food consumption will grow quite rapidly as a consequence of these two factors. So I think we will underestimate discretionary consumption. And therefore, I think that's a sector to back for the medium term. As a consequence of household leveraging, I think there's going to be a big boom in retail loans. Okay. And therefore, financials, I think, will also do quite well. In the financial sector, however, there is a lot of disruption that's likely to happen. And that's coming from technology, it's coming from regulations. So those things will create, I think, some difficulty in picking the right stocks. But one narrative I think is quite clear, is that the state-owned banks will lose market share. So sitting at 70%, I think they're likely to give up 10, 20, 30%.
So none of them on your list? No,
none of them on our list. You could trade in them, but I don't think you should invest in them. Okay. And the trading rallies can be quite powerful, as we've seen over the past few months. But then, you know, they'll probably give up performance as their valuations get full and the structural factors start impeding them. Because I don't think the government is in any hurry to put meaningful capital to work there. So they're starved of capital. And I think they will lose share to the privates and to the non-financials.
You spoke about government investment also being fairly rich. None of your stock, reflect that. We don't have the Larsons in your list, or the ABBs, or all those various road construction companies.
Yeah, there's a technical issue because our industrials coverage is in transition. So right now we don't have industrial stocks in coverage, but we'll soon have them.
Ridham, to take your call on financials forward, I think recently your team upgraded the NBFCs, the likes of M&M Finance and Shriram Transport. Without talking about individual stocks, broadly, what is the sense on the NBFCs and why you like that space?
So there is a disparity in valuations. Some of them, I think, have turned quite attractive and have fallen to 2 times book. There are others that trade at 6 times book. And I think in a bull market, if you're looking for 1-year returns, there's always opportunity for you to switch from one side to the other side. And the other side plays catch up, and then you give up on one side, which is expensive. So that's exactly what we are doing as well.
Okay. Well, Anuj and Sonia are itching to ask you questions. Anuj?
Ridham, good morning. Slightly disappointed that you're not hosting me and Sonia this time for closing bell. It's an annual ritual, but I guess your schedule is very tight, so I'm going to give you benefit of doubt on that one. Maybe next year, we'll have our normal closing.
I'm not disappointed. I'm fine. I'm fine sitting here in the studio.
No, but Ridham, you spoke about this being a 2004 kind of scenario. Let me be a devil's advocate. In that case, let me be a bear's advocate. We heard all this argument in 2008 as well, that there's enough liquidity and the market is just going to keep moving, and we saw what happened after that. Do you think there's a bit of a risk right now that with so much complacency around, you look at the volatility index both in US and in India at historic lows, do you think there's a bit of a risk that we could have a significant correction from here on?
So Anuj, you're shifting the debate from the medium term to the short run, and I think in the short run there are factors to worry about. Clearly, depressed volatility is a reflection of market sentiment, which is quite rich. And as I said at the outset, when you're making a call on the market when valuations are middling, the only tools you have is your assessment of the growth cycle and where sentiment is. And I do think that sentiment is quite rich. I'm looking for the trigger which will cause the market to correct, and I think the trigger actually could be GST. Now, we just completed a comprehensive survey of India's micro and small manufacturing and services companies. See, these are not your typical listed entities. The listed entities actually all get classified as large companies. India has 9 million firms. We're talking about the tail end of these firms, and that's 99% of India's enterprise universe. Our survey shows that almost half of these guys are not prepared for GST launch on 1st July. In fact, 90% of them have expressed desire for training, and we're about less than a month away. So there is a possibility that as GST gets launched on 1st July, we face some amount of disruption in terms of growth. Now see, the market can react to this in two ways. One is the market can say that this is fine, we know this is temporary, GST is a great long-term reform, and this disruption will go away in a quarter or two, and therefore let's move on. And nothing happens except that the VIX index climbs up and realized vols climb up. But the index actually doesn't do anything much. However, if this is combined with a global event, because mind you, a large part of India's bull market at the moment is also driven by global factors. It's not just local thing which is happening here. We have to remember that Europe, US, Japan, emerging markets, all of them are going up. So if there's a global event of some sort, which I can't actually predict here, and it gets combined with some disruption on GST, then you could get a drawdown on the Nifty, which could be in the 5 to 10% zone. So I don't think we can rule that out. I think it is for somebody who is trying to trade this market and who's not looking at it from a 3 to 5 year perspective, I think they can wait on the sidelines. It's not yet time to short the market, I think. I think shorting the market may be a little bit too risky because the time frames really shrink there. But it may not be a bad thing to just wait on the sidelines and, you will get your moment. We got a great moment in December. The only problem for retail investors is that when that moment comes,
they don't buy.
They will not feel like investing. Because nobody was wanting to put money to work in December. We were discussing this on 2nd of December, I think, that demon will be forgotten in a couple of months. And now is the time for people to put money to work. But that's always the most difficult moment to put money to work. GST is very different from demon. I classify demon as an unknown. GST is a known unknown.
That's exactly what I'm saying. Won't everyone think that way? That, if this did not give you a dip even for demon, will this really give you a dip in GST? So even this dip, are you anticipating?
No, so there was
We're changing roles. He's playing bear and I'm playing bull.
No, there was a serious dip in demon. Let's not forget that. We had a 1,400 point dip in the Nifty, and it looked very bleak in December, and growth forecasts were being cut, and people got quite concerned. we may not get a similar type of thing on GST because of this difference, which is that GST is a known unknown. But let's not forget it, GST is uncertainty. See, I contrast risk and uncertainty in this fashion, which is risk is something that can be quantified. Uncertainty is something that cannot be quantified. And I'm struggling to quantify GST, both in upside as well as downside terms. I mean, imagine the lift that GST is going to provide to corporate profitability over the next 3 to 4 years. But if you ask me to quantify what will be the inventory gains, what will be the warehousing cost gains, what will be the freight cost gain, what will be the input credit cost gains, I have no idea. I cannot even start with a number. So that is the problem with GST, is that it falls into the bucket of uncertainty. So if it is combined with a global event, then I think you could get a bit of a drawdown in the Nifty. So that's for people with a 3 to 4 month view. I think it may pay to be on the sidelines for a while. And especially in mid and large, small caps. I think that's where the risk is actually greater than and large caps. And we saw, last week, for example, or the week before, when there was a little bit of a correction, how mid and small caps corrected. That was bid, because still, even today, there's a bid on the screen. That's liquidity, right? But that bid can go away if the markets get a bit nervous about these impending events.
Sonia.
Ridham, hi, morning. Just to follow up to that point you made about the global curve balls that could be thrown at us perhaps. The one big pillar of this market has been domestic flows over the last 12 to 18 months. It's as though the importance of FI flows has gone down. So even if we do get any kind of global upheaval where FIs pull out, do you get a sense that, the domestic market could still keep this, our own Sensex buoyant?
So, Sonia, flows are a lagging thing. Okay, price is what leads, flows follow. That said, with that caveat in mind, I think domestic flows are here to stay. We published a report, an update of what we had done 3 years ago. We call it the super cycle in domestic liquidity. We're forecasting humongous flows into equity markets. If you see it from current rupee terms, numbers that range between 4 to 500 billion US dollars over the next 10 years. Conventionally, all of us look at only one source of domestic demand, which is essentially domestic mutual funds, and that's the only one that's actively measured. But there are 3 new, very big sources of equity demand coming from domestic sources. The first is insurance. It's back. After the hiatus of 2008, the regulatory changes that happened, insurance is back, and they are going to be a fairly consistent buyer of equities. Unlike domestic flows where, things can go up and down, insurance will be buying almost every month. The second is national pension scheme, and the third is the provident funds. These 3 put together are going to be big buyers of equities over the next 10 years. And in fact, for NPS and for PF, I expect it to be a geometric progression, not a linear progression.
Any numbers you have done for the current year itself?
No, we are not done. This is still starting from a very low base. So the numbers this year will not be meaningful. Okay. But PF has already disclosed what they're going to say. And they're going to tell you in advance the actual number, because they know their assets and they know what the flows are. However, think about this, as more and more people join the formal economy, which is what is going to be the consequence of GST, there will be more and more people on national pension scheme and on provident fund. Today, you have 15% going into equities. That number will also go up. That's been going up every year. So it's quite possible that number ends up at a much higher level in 10 years. We're not even making those assumptions. Okay. Just with the current growth in income and therefore the growth in these assets, we can sense that over a 5-7 year period, these guys will be big buyers of equities compared to domestic mutual funds right now, and definitely compared to foreign investors. So on the aggregate, domestic investors will far outstrip foreign buying over the next 10 years. Just to put it into context, over the last 10 years, or in fact since inception, foreigners have bought $170 billion of Indian equities. Okay. We're talking about a number which is somewhere between $400 to $500 billion over the next 10 years. So this is a staggering amount of money. So going back to Sonia's point, of course, domestics I think will provide demand for Indian equities, but that can always go away temporarily.
So Ridham, just to take a point forward, only 2 weeks back, Rakesh actually talked about your report of $400 to $500 billion of domestic. In fact, he feels it'll be your report is very conservative, and there will be much more flows than what the street is expecting. So probably that's where everybody will go wrong in terms of how to map the domestic flows, is what even Rakesh had a view. when we spoke to him 2 weeks back. One question, Ridham. I had 5 questions for you from your report. You've replied 4 of them about valuations, exuberance, sentiment. How should one participate in this market now, given that the opportunities are quite scant?
Opportunities are quite?
Are quite limited because of
No, I don't agree with that. Why are we saying opportunities are limited?
No, I'm saying, given that from a bottom-up
See, I'll
approach,
tell you why opportunities appear limited. Is because most of us tend to get anchored to the winners of the past 3-4 years. And a lot of those winners trade at valuations which do not warrant further investments. But if you start shifting your attention to a host of companies and stocks that have actually not participated, I think there's enough juice in this market. So I don't think the opportunities are limited. Certainly not. So, it is reflected in our recent upgrades.
Yeah.
I mean, there are NBFCs that trade at 2 times book.
Okay, let me just
People don't want to buy those stocks because they are worried that they trade at 2 times book and not 6 times book. But I think you have to shift your attention when the valuation risks are as disparate as 2 and 6.
You have a 24,000 bear case.
Yeah.
Why? What might lead to that?
So, Lata, I think it's a very good point you make, and I think I should use this opportunity to explain that there are 2 purposes served by index targets. One is to highlight the range of outcomes, which could be enormous over a 12-month period. In fact, over any time frame, even over a 3-month period. So the range is pretty wide, and usually it is wide because a lot of unknowns are there which we cannot actually foresee. The second is that targets actually provide some semblance of discipline. Okay, so they're not to be viewed as levels at which I think the index is going to go, but more as levels which instill some discipline about how I think about the market.
Okay.
So those are the purposes that index targets serve. So there are things that can go wrong. Things could go wrong with GST implementation. Things could go wrong with India's macro. And that demand may not recover as we are forecasting. Things could go wrong globally. So I think there are enough things that can go wrong which could cause the market to go down. We're attaching a 20% probability to the 24,000 scenario, which is not an irrelevant probability, but it's not irrelevant probability, but it is on the lower side compared to our base case and bull case. Yeah.
Fair enough, Anuj. Yeah. Okay.
Also, just that we have rolled our index target, so now we have a new target. Which is for June 18, which is 34,000, which says that there is likely 10% upside to the index. And this is very much in contrast to where I was in December, when I was far more bullish with a much bigger upside to the market. So I do think that returns are likely moderating over the next few months.
Okay. Ridham,
Second half of 2017, I think, will be less attractive than the first half, is our current view.
Okay.
Okay. Ridham, just to caveat that view that it was not my view. I'm an eternal optimist and share your view in terms of the long-term market move. Just was playing devil's advocate, but 2 sectors where
don't get so defensive, Anuj. It's okay.
Yeah. So two sectors.
None of us have an idea of how the future will
absolutely.
pan out.
And we
all have to eat our words.
We keep chatting about it on WhatsApp all the time, Ridham. But a couple of points. Last time we invited your pharma and real estate analyst. These were 2 sectors where you had sort of contra longs. Real estate has worked beautifully for you. Pharma has not. Thoughts on these 2 spaces?
Yeah, so we have given up on pharma since then, so a while back actually. So we are underweight on pharma. And I think there are structural problems there which don't go away very easily, and I think the valuations are still rich. In contrast, we actually like IT, where also there are structural problems, but the valuations are more attractive. So between pharma and IT, my preference to IT shifted at the start of the year. So we made that shift actually, but even IT has not worked out. Both pharma and IT have gone down. Pharma has probably gone down a bit more than IT, but even IT is down. So it has not worked out, the contra bet, and I'm waiting for it to turn. Let's see how much it tests my patience and if I give up. But for now, I think IT represents good valuation risk. For those who are a bit more technically minded, I could highlight the fact that the correlations between IT sector and the index are running at 2 standard deviation below average and in negative territory, which means that if the market goes down, IT could likely go up. So it provides you a good hedge if you don't have other means of hedging yourself against a risk. But you know, I have to admit that neither of them have actually worked quite well for us.
Okay, you look for space. You said that you will look for spaces where valuation is still not rich, and you're giving us one. Thank you very much, Ridham Desai, for spending time with us. What we will remember is 34,000, your base case by June, and 30,000 Nifty in 5 years.
Next 5 years.
That's what we will remember.
That's
from
the
this
headline for us.
conference.
Thank you.
Back to you guys in the studio.
Okay, thanks a lot. It's always a pleasure to listen to Ridham Desai, right? And a lot of important comments coming in there. The Nifty could triple, ladies and gentlemen, in the next 5 years. That's the view from Morgan Stanley. You'll, of course, get to hear excerpts of that interview through the course of the day. But let's move on now and get you some money market views that you could look forward to. Bhaskar Panda of HDFC Bank says the rupee has showed strength and is trading near the 64.30 pivot, which is expected to hold. He expects the dollar INR pair to trade within a range of 64.30 to 64.50 for the day. And on the bond market, Bhaskar believes the 10-year benchmark yield has continued to move down on the expectation of a dovish pronouncement in the coming policy tomorrow. He expects the yield to remain range-bound within 6.62 to 6.65% for today. Okay, let's take a break. We haven't done that in a bit. When we come back, it'll be time to talk micros, the CNBC TV 18 top 10 list of stocks to watch out for. Stay with us.